as Aman put it. Aman, coming back to you, but let's go across to Lata now, who in the morning was telling us this is preview that maybe we should expect fireworks, and I think fireworks is what we've got. Lata, over to you.
Well, since this is RCB week, let me start with some cricket analogies. The governor actually came out and batted like Josh English, didn't he? I mean, who expected so many sixers? A double rate cut, 50 bips, and a 100 bip CRR cut. I can't remember when we last got a 100 bip CRR cut. Was it during the Lehman crisis or something? Even last November, Shaktikanta gave us only a 50 bips. So that was like really mind-boggling innings. But then he just got converted himself into, what do you call it, Rahul Dravid? I know that's my times, but just went back to the crease, as it were, and changed the stance from accommodative to neutral. So what does this mean? It doesn't mean more cuts. It means the August cut has been advanced to June. That's the only way you can read the word neutral. And also, neutral should more likely mean that there are no more rate cuts. There is the chances of a further rate cut and taking the repo to 5/4 now drops very steeply, because I specifically asked the governor that, and he said, you may have a 3.7% inflation cut now, but next year it is 4.5%. So that is exactly what the market wanted to hear. If you are looking at the inflation at 4.5%, then you have to add that 1.5% positive real return. Then you are at already at 5.5%. There is no further scope to cut rates. So chances are the market will get used to that idea. That's about bonds. So the bond rally kind of peters out because of that. It kind of, has to stop over there. The other important point that he made is the impact on banks. That's the CRR cut. Immediately, the repo cut is what comes into effect. CRR comes into effect from September. The repo cut of 0.5% not expected, which means about 30% of the loans of every bank suddenly gives you 0.5% less. So it's going to be a bad first quarter for banks as far as their margins are concerned. But it starts improving, because once the CRR cut starts factoring in, then, your cost also becomes cheaper. And as the year goes by, all your deposits start getting repriced. And therefore, banks are likely to exit the year with a very good margin. What the SBI chairman very beautifully put up as a U-shaped curve as far as the margins are concerned, fall and then rise just as dramatically. That's the story on banks. Exit FY26, very good. And for the rest of the market, the interest rate sensitives, NBFCs, real estate, those depending on consumer loans, even autos for that matter, I think it's a very, very good deal indeed, because we are going to see retail loans actually, getting cheaper and cheaper as the year goes by.
No, absolutely. Lata, thank you very much for that. And I think